My mom really wonders what I'm doing when I say I'm shorting the VIX to make money. I explained to her that the VIX is a fear gauge, and that it's based on the S&P, the SPX options prices. Am I getting it right when I say that?
Yes, yeah, the VIX takes a collection of out of the money puts and calls and runs it through a calculation to arrive at the VIX number. And it's kind of interesting, actually. It does not use a preconceived model like the Black and Scholes model. It's actually what they call a model-free calculation. So theoretically, it's actually quite interesting.
Now, when did the VIX start come into being?
So the initial calculation, that's a good question. I believe the initial calculation started in 1990, but it used a pretty different calculation back then. It actually was using near the money options prices, and it was on not on the S&P 500, but the S&P 100. So in 93, they came along with this different calculation. That switched to the S&P 500 and then went to a much more elegant calculation that takes that's sensitive to the out of the money puts and calls. So it's much broader in the sense. And it turned out that it was critical from the CBOE's ability to have futures, because when the initial pass at it, which is now called the VXO, you can still get quotes on it. It couldn't be hedged well enough for the futures market makers to be interested in it. So when they made the second pass, then it made it so it could be statically hedged instead of a dynamically delta hedge sort of a situation, and that made the difference. So that the futures market was created, and then you get the futures options, and then ultimately you get the exchange traded funds.
Because I remember I was a trader at the CBOE from 1994 through 2002, and during the crash, the biggest pit was the 100 pit. We call it the OEX pit. So and the SPX was coming into prominence when I was there. It slowly gained in order flow until it was definitely dominant by the time I left there.
That's interesting.
Yeah, so I can see why. Like, guys that made money in the crash at the CBOE were in the OEX pit, not the SPX.
Just because they had more volume or more liquidity, or
that was the spot. That's where everybody was. It was a bigger pit, and that's where everybody was. It was already phasing out though in '94 by the time I left there though. So I've been aware of the VIX since. I know it's just a number. Is it calculated? Correct me if I'm wrong. It's calculated every 15 seconds.
That's how often they do updates. Yes.
And it's not open 24 hours. How does that work? Is it just open when the options are?
Well, it's calculated off SPX options. So theoretically, you can do it any time when the SPX options are active. And actually, they run pretty much 7/24 now. I think there are a few down periods, but it's certainly a lot more active than it used to be.
One of the main features of a lot of these products is that they seem to go straight down. Volatility can say the same, but a lot of these products go straight down. The one that I've been most involved in has been UVXY. And I know that there's a term structure, which is a way of looking at the different futures and how they relate to each other. And in general, the futures are in Contango, meaning that the farther out month ones are higher up than the front month future. And then every day, UVXY rebalances at a certain point. And what I learned from you is that rebalancing doesn't actually cause UVXY to go down. I initially thought that But I found out now that that it's just the futures falling towards spot that makes UVXY go down. Now, if I wanted to get long volatility, could I just buy the futures? Would that be a better way to play being long volatility?
Well, it turns out that, well, that there's a couple issues there. One is the futures expire. So is if you start buying futures, then you're in a situation, if the move isn't immediate, then you need to think about a roll strategy. And it's not just the inverse, it's not just the ETPs that suffer from this decay. That's also present in the futures, and the exchange traded products just effectively reflect that. So so you really don't gain anything with using the futures. There's some tax advantages and some areas like that, but in terms of participating in the market, there's really you know, they're pretty much the same. So one thing when you mentioned about UVXY and VXX seeming like they're always dropping like crazy, well, I think it's been a long time since we've had a real volatility spike. So you think that they drop now, and they do. You know, the UVXY drops like 90% per year, so it's a huge drop. But if you get a volatility spike, these things can really go straight up, and they can really move on the upside if volatility is climbing.
So there's a case to be long these products at particular times then.
Well, if your timing is perfect. Although in the case like 2011 or back in 2008, 2009, actually you would have done very well staying in those products for a long time, because the term structure, you mentioned the term structure, if the futures as you go out in time, if they're getting more expensive as you go out further in time, then there's a headwind for the UVXY and the TVIX, the long funds. But the other shape is called backwardation, and that's where the futures get cheaper as you go out further in time, and that ends up being a benefit for these long volatility funds.
I heard that in 2011 that the futures were in backwardation for 76 days. Is that true?
Yes, yeah, and you know, I remember that cycle well, because we'd seen two big volatility spikes, and so we I kind of felt like, all right, we're safe. So I went short vol, and then there was this third massive spike that came along. So at that point, you really have a rattled market. It hadn't been that long since the Great Recession, and I think that you know, the level of the VIX stayed up for quite a while. After that, it wasn't like we see now, where you tend to have a vol spike and then it collapses relatively quickly after. This was sustained, and I don't know the number offhand, but the backwardation was even longer for 2008, 2009. I'm sure it was over 150 days in backwardation.
Now there's everybody follows the difference between the M1 and the M2 future, that percentage amount. Today it was huge. It's like over 14%, I believe. But I'm sort of interested in the spread between the spot price and the M1 future. I sometimes call it the roll yield. I don't know. Everybody has a different name for it. But it seems to move around. So, for example, right after expiration, it could be as high as $2 to $3, and it slowly shrinks on the way to expiration. But it seems to sort of act as a shock absorber between the futures and spot at times.
I know a lot of people when they think of Contango, they tend to think of the slope between M1 and M2. But I actually think you definitely have to pay attention to the spot, because there are configurations, for example, where M2 might be higher than M1, but spot might be higher than both of them. So when you have a case like that, then the tailwind is in the advantage of the long funds. So I think that paying attention to that either premium or gap between spot and M1 is really important. And I think it tells you where the futures are going to go. The spot is ultimately where that M1 is going to expire to. So I think it's very important to keep track of that.
It seems like when it's something sort of crazy happens during a day, stuff will go out of whack where like the term will move in a strange way. Maybe the M1 and the spot will be the same for a little bit, but it seems like towards the end of the day, they try to bring it back in line. Now that's just like on a one-day spike, I guess. I'm from the short-term traders who haven't experienced the craziness of a 2008 or even of a August 2015, I believe was a was a big one. Now, so UVXY right now, it closed today 11 and change. If the if the SPY were to drop, let's say 10%, would it go to like 200? Would it go to 100? Would it? Because the high of the year was, I think, between 150 and 200. Would it go that high if the SPX were to spike?
So in terms of the VIX or the price of UVXY?
The price of UVXY.
Okay, so well, first of all, when you say 10%, are you talking about a single day move or just a or a series of moves?
I guess it matters, doesn't it?
Yeah.
I was thinking if we came in tomorrow and the markets were down 10%, could we see, would UVXY go to 100? Would it go to 1,000? What would happen? I don't really know the order of magnitude as to how much it could go.
Right. Well, and it varies some. So we're obviously in a very low volatility period of time. And if you look at the data, that actually increases the VIX's sensitivities to moves in the S&P 500. So normally, let's say realized vol was running in 12% annualized, and you had a 1% move in S&P, you might see like a 4x that in the VIX or higher. So now, right now in the low vol environment, we're seeing moves of like 20 or 30x. So you might see a 0.5% move in the SPX, and you're seeing a 15% move in the VIX. So if you had a 10% move in the S&P 500, you would have a huge multiplier in terms of the VIX. So then the futures, typically the futures track the VIX percentage moves at about 45%. So if the VIX went up 10%, the future M1, well, the kind of the average of M1 and M2 is going to go up about 45% of that.
Wow.
So when you have a big, huge one-day spike, though, it's not that high. So historically, if you look at the flash crash in 2010, you saw numbers more like 20 or 25. Or you mentioned the August 2015 crash, same thing, where you didn't see this 45% move in VXX or 90% move in UVXY. You saw more of a 25, 30% move. But you would so the sort of factors you're talking is you easily get a 10% move. You could easily double or triple a UVXY. That would be not hard at all if you had a massive move in the S&P.
So you've got people trading options in the SPX, and then you've got people making markets in the VIX futures. And then every day you've got these ETFs and ETNs rolling their positions. It's hard to tell who's actually moving the market at times. Is it the futures guys making a decision like we're going to bring these up or down, or is it the SPX, or is it the effect of these ETNs and ETFs rolling things the most? I tend to think it must be the SPX puts that are the predominant factor involved. What would you think?
Well, I think that certainly when the VIX futures started, they were a very small component. The SPX options market has been growing pretty dramatically too. So the market cap of S&P 500 is like $10 trillion. I think overall kind of in that range.
Wow.
The There are some people I really respect, though, that think there's a transition going on, is that the ETPs and the VIX futures are starting to feed back into the S&P 500 options. And one of the arguments for that is just looking at the amount of Vega which is an options Greek that basically says that for a given move in volatility, what does that translate into dollars in the volatility markets? So the VIX futures do that directly because they're priced in volatility. So if vol goes up 1 point, you go from 14 to 15, that translates into $1,000 for that contract. On the SPX options, it's more indirect because it shows up in the pricing, but via the implied volatility. So it's not as direct. But I would say my opinion is I still think the SPX is driving it, but it's not tight. You know, it's not a real tight relationship because you can see the VIX spike way up and not much movement in the futures. So if they were really closely tied, I think you'd see a tighter coupling there.
Like there'd be some sort of arb where if the VIX futures went up, someone would actually go in and start buying SPX puts against it or something like that. Like a basket.
Well, yeah, and ultimately there is arbitrage, but I think it has to get into the plus or minus 5 to 10% range before it starts becoming profitable to arbitrage that.
I wanted to ask you, one of my friends had a question for you, which was, I know VXX is ending. It's ending, I believe, in January of 2019. What's going to happen? Are they going to release a new VXX, or will they just extend the date?
Yeah, I've been looking at that for a while, and I did talk to a Barclays guy quite a while ago, and he assured me that there would be a follow-on product. He said they can't just extend it, so they can't just do a nevermind and add 10 years onto it. So I think, and I've also seen the OCC, the Options Clearing Corporation, they're putting out notices about options being cashed out and those sorts of things at that same point. So it's going to be a big deal. So what I think will happen is that VXX will cash out at the indicative value on that date. And I think, I don't know the exact sequence, but it seems like what they might do is start essentially a new version of the VXX a couple weeks before with a different ticker. And then as soon as VXX dies, then change that ticker over back to VXX to reclaim that.
Yeah, because I go to this website called barchart.com a lot, and they show unusual option activity. And there's a ton of options volume in VXX lately. I mean,
oh, yes.
There's been size, and I think that's where well, I guess it's in the VIX where that 50-cent guy goes. But regardless, there's been some big size options trading going on in VXX as well. I mean, UVXY is dwarfed by those products.
Well, I think just in general, the volume of the volatility products has been climbing. So, obviously they're not still at the dollar level of SPY, but in terms of just daily share volume, there are days when VXX trades more shares than SPY, which used to be the most frequently, highest volume product out there. So, and certainly if you add up the whole volatility complex, normally these weeks, their combined volume is higher than SPY's volume.
Oh, wow. That's amazing, really.
It's still not popular. It's still not dollar volume, but just in terms of shares, if you look at, highest volumes. And as you say, the volume, I know the VIX options set a record last week in terms of their volume. So they continue to become more and more popular.
Now, shorting volatility by getting long these ETNs and ETFs, the SVXY, XIV, ZIV, XIVH, these sort of products has become very popular. But we read about how there could be a drawdown actually to zero on one of these if we get a big enough spike. Now, is that possible that like XIV could go to zero?
Yes, yeah, that's called out in the prospectus, and actually for them it's a intraday 80% drawdown. They have certainly the option to terminate the fund at that point.
So what would happen if you own shares in it then, and the fund gets terminated?
Mm-hmm. So basically, they pull the trigger on it. Um, they would close out the positions at whatever price they could get, and then at the end of the day, you're guaranteed it won't go below zero. That's the only thing you're guaranteed. And if they, let's say volatility rebounded at that point, let's say it touched 80% and then started, if volatility started dropping, then you could get 30 cents on the dollar or 40 cents on the dollar, but you would get a major haircut. SVXY, they're not as clear what they don't have a set number like that, but again, they guarantee they won't go below zero, which is actually an advantage, because if you're like short VXX or short UVXY on a really bad day, you can go negative. You can definitely lose more money than you initially put in play. So it's kind of a sideways benefit, kind of a zero cost put, that these inverse products won't go below zero.
Yeah, well, there's at least that with them, that it can't go below zero. If you short,
looking at the bright side, yeah.
You're talking to a guy who's currently short naked calls in UVXY, so I feel the pressure from that. Let me ask you about two other products, and I believe these are have some discretion by the managers to sort of trade them. One of them is called MRPAX, and the other one is called VMIN, and they both I believe have some sort of discretion, whereas the other ones are just like a formula.
Okay, so the VMIN I'm quite familiar with, the REX ETFs, and essentially what they do is that they're trying to get higher leverage. So they have the option, they're not required to, but they have the option to go into the weekly VIX futures. So you can, the way that VXX and XIV, SVXY are set up is they have essentially a 30-day horizon. They mix a combination of M1 and M2 such that you effectively get a 30-day volatility horizon. Well, if you mix shorter term futures, there's no reason why you can't get shorter and shorter volatility horizons, and the closer you do that, the closer you tend to track the VIX. So for example, with a VIX future, it has a day to go, it's going to be tracking the VIX percentage moves at like 85% level, whereas VXX tracks it at about the 45% level.
So we don't have to be concerned with like some fund manager kind of swinging for the fence on that somehow and losing our money.
No, they would, the reason that they're active and have management is because when they first started, the weekly VIX futures were just getting started, and they weren't real liquid, and the spreads were pretty wide. So the bid-ask spread. So I think they just wanted that flexibility to not be held hostage to the market at that point. Since then, the market in those weeklies has gotten pretty good. So I think right now their limitations are more, they're restricted to what percentage of their assets they can put into futures at this point. So I think that's kind of limiting their leverage at this point.
Well, I'm sorry, I didn't mean to interrupt you.
No, go ahead.
I've played VMIN a little bit this year, and it's done gangbusters. It's been a great investment for me. And when you talk about the spread, the one thing about that is it's usually pretty wide, the spread. So, but I've been able to get filled mid-market on, I'm relatively small. I just put a bidder and offer mid-market, and have been able to get filled. As long as the market's not moving too much, I don't feel the need to be real aggressive.
Well, and I think that's something, I have written some posts on that. A lot of people think that, that they have to abide by the bid-ask spreads, and there's nothing to be lost by going in there with a limit order between the bid-ask, and sometimes you can get a good fill. Mid quote is not all that unusual on some of these funds, and certainly worth a try.
Yeah, same with the options. I have a friend who has been playing this strategy of buying put spreads, and we've been able to get filled mid-market on these put spreads at what we think is fair value, which is great. I mean,
yes,
that's the benefits of being a retail customer these days.
Yeah, no, it just kills me when people just hit the bid or the offer. It's just leaving a lot of money on the table.
Well, being a former market maker in the options,
yeah,
I used to encourage it.
So you mentioned another fund. Can you what was the ticker on that? Or
Mr. Pax. There's a guy I follow on Twitter who's, I think, the fund manager for it. Let me look it up real quick. I believe it's just a volatility fund that's privately managed.
Okay.
Let's see. I love this research in real time.
Yeah, that's
Measured Risk Strategy A, it says.
Okay, yeah, so I am familiar with that. That's a mutual fund, and
Okay.
the tickers are MRPIX and MRPAX for a different class of investors. So my understanding is they are an active fund and option based. So my understanding is they're much more, the classic active investing strategy where they're looking at market conditions and trading volatility options based on that.
Well, I know that one's done pretty well this year too. So, well, I wanted to ask you just to get to know a little bit more about you and your story. I know you worked for Hewlett Packard for a while.
Yes.
What got you interested in volatility?
So my background is electrical engineering, and I worked for Hewlett Packard for 30 years plus in various spinoffs. Started getting interested in the stock market in the late 70s, and so read some books and started tracking that, and actually got into doing some options back then too. So my first recollection of the VIX proper was in the 2005-2006 timeframe. And I thought I was really intrigued because I think one of the big challenges of investing is coming up with an asset that's reliably, for diversification, that's reliably negatively correlated with the market. Because you look at most portfolio strategies and they'll spread out into lots of stocks and they act diversified when you don't need it. If the market is going sideways or up, you don't really need diversification. And then when the market panics, what happens is all these asset classes, with the exception of fixed income, all the equities tend to go into lockstep and all drop very quickly. So your sector diversifications or all your different strategies don't work very well in down markets when you really need it. Whereas you can pretty much guarantee that volatility is going to go up when the market is panicking. So that was my initial interest, is a way of diversifying an overall portfolio. And just being an engineer, wanted to know how these things work. So I've just progressively dug deeper and deeper into understanding that. And then there's new products all the time to get into and understand also.
So did you initially employ a strategy of getting long vol alongside your portfolio and have it start to go against you? When did it dawn on you that there's such headwinds here?
Well, I bought some VIX options in 2007, and I was about 3 months early. They expired right before volatility really started kicking up. So that was just the first of bitter lessons of how hard it is to time the volatility increases.
Well, I'm part of a group of guys on StockTwits, guys and gals too. I correct myself. And we all read your articles, and you're sort of like the godfather of the VIX to us, because we love your articles. I mean, you put it so clearly and easy to understand. It's not a super complicated thing, but it requires understanding a little bit. And there's many newcomers that come into our thread, and on StockTwits, the UVXY is sort of seen as a lottery ticket.
Uh-huh.
So
Yeah.
people have an extra, $1,000 and they want to bet that maybe the market's going to crash tomorrow. They'll buy a little UVXY.
Right. Right.
And then there's another core of us who are the people we see ourselves as sort of selling lottery tickets.
Mm-hmm.
And it's a pretty big community of people now that are actually actively shorting these products all the time. I've been doing this with some of my guests. I just wanted to do a little thing with you just to learn a little bit more about you, if you'll indulge me for just 1 second here. This is a little word association here. Let me see if I can get it here. Okay, so I'm just going to say 2 words and you say which one applies. Ready? Okay. Dog or cat?
Cat.
Netflix or YouTube?
Netflix.
Phone call or text?
Phone call.
Facebook or Twitter?
Twitter.
iOS or Android?
Android.
Mac or PC?
PC.
Good. I agree with that one. Big party or small gathering?
Small gathering.
Football or basketball?
Football.
Jogging or hiking?
Jogging.
Car or truck?
Truck.
Coke or Pepsi?
Coke.
Ocean or mountains?
Mountains.
What is your favorite television show?
That's a good question. I certainly enjoyed Broadchurch. I like the murder mystery, especially the UK does a good job there.
Excellent. I've been watching that with my folks lately.
Yeah.
They did it. Sure. They did an American version, but it just doesn't fly.
Yeah. There's one called Hinterland that's set in Welsh, Wales. So it's kind of a similar thing. So when you finish that, that would be a recommendation if you like Broadchurch. So
yeah, the American version has David Tennant trying to speak with an American accent. It's really, yeah,
that's a disaster.
Yeah, it's really pretty funny. Let's see. When was the last time you took a vacation?
About 4 months ago.
And I wanted to ask you also, when I talked to you before, you said I believe your son trades Bitcoin.
Yes.
Are you interested in Bitcoin at this point?
Oh yeah, I actually own 0.068 Bitcoins. I sold a spreadsheet. I sell spreadsheets on my website, and I got an email from a guy saying, well, I want to buy one of your $30 spreadsheets, but I want to pay for it in Bitcoin.
Oh, wow.
And I said, oh, what the heck, so I'll learn new technology. So that was like 2 years ago. So
well, that's worked out so far.
And my son has been a visionary on that. He was all for Tesla at 9, and he's been in Bitcoin for quite a while. In fact, I think he lost a couple Bitcoins at some point. So I think that that's painful at this, but he's definitely involved with that, and I'm kind of staying out of it because I discouraged him on his Tesla trade. So I think his instincts are probably better than mine on something highly speculative like that.
Well, it's so hard to reach for those tech stocks that are trading in the hundreds of dollars. Bitcoin seems really hard to value for me. 2 guys in my StockTwits group, though, are trying to convince me to get into the cryptos, and they actually sent me a little bit of Litecoin. So I have 2 Litecoins now, so I'm on board as well.
Yeah. No, it was interesting watching the CBOE's Bitcoin futures. They started trading yesterday, and they're off to a really good start. So I think that we'll see options similar to VIX options only on Bitcoin in a couple months is kind of my sense.
So do you think, yeah, I saw that yesterday. There was a little bit of trepidation. It went down to 1,400 and something, but then just skyrocketed back up. I think it's over 16,000 now again.
Yeah, and it's interesting just looking at the term structure is there were no one really know what to expect, but someone described it. I think the premium is like 6% or 6 to 10% over spot. And they called that kind of a convenience fee. I think the market makers, they have round trip transaction fees, time value of money, and, bid-ask spread. So, at least with all of 2 days of trading, we're kind of getting in a fairly flat term structure. So the Bitcoin prices futures don't climb much as you go out in time, which is, I think that's very understandable. So.
Yeah, I'm glad you mentioned that, because many people whose only experience has been the VIX were assuming that somehow there was going to be a similar play in the futures.
Right.
But I know there's a similar situation in oil, but it's not that every futures contract has the ability to arb, contango.
Well, I think that's a huge misunderstanding on futures. Is you really should think of futures as not being a prediction market. That the only time prediction gets into it is if there is a seasonality. For example, you think about wheat or something where you have a harvest, but futures aren't a predictive market. They're actually more, if a better understanding is they're valuing the cost of storage. So you mentioned oil, and natural gas is even worse. These things are really expensive to store. So when you have a commodity like that that's hard to store, and actually the VIX is the same way, is SPX options. They do not store well, they decay. So any commodity or thing that you have futures on that has high storage costs, you're going to tend to have a lot of contango. Whereas Bitcoin, it's not going to decay, and the expectation is it'll go up. So for that reason, I don't think we'll see much contango in the term structure.
Yeah, I always thought of it. That's a good point you have about the sort of a little bit of a premium for execution difficulty with the wallets and losing Bitcoins and all that stuff. But I always just thought of it as the difference in futures would be a cost of carry. And the way cost of carry was explained to me when I learned to be a trader was just as if every player comes into the market with no money. If they need to borrow money to buy a future, they're going to have to pay interest on that money for the time until the future expires.
Right. So basically, if you have to borrow money from a bank in order to buy the underlying commodity or whatever, then that's reflected in the futures cost.
I wanted to ask you also about the VVIX and the VXST. People always say to watch those two, and if the VXST is higher than the VIX, or if VVIX gets up above or near 100, that means changes in the air. Is that true?
Well, the VVIX it's the volatility of volatility. The CBOE actually uses the VIX algorithm instead of on SPX options. They do it on VIX options.
Oh, okay.
So you get volatility squared effectively. And anytime you have volatility kick up, that's increase, that's an indication that there's market action, and usually down in that situation. Usually if the market's going up, volatility tends to drop. So as an indicator, I think it's certainly a decent one. I think we'd all love for VIX or VVIX or any of these to be predictive, but I think you're looking at it analytically, none of them are convincing from a historical predictive ability. So the VXST is a short-term volatility metric. So the VIX is a 30-day horizon of volatility. The VXST is a 9-day measure of volatility.
Okay.
So what you tend to see is when the market gets nervous, the first thing that tends to move is like the short-term options are about to expire. So it's good from that standpoint, but the big problem I have with the VXST is I think it's just a methodology, a metrics problem, because for simplicity case, for the case of simplicity, the CBOE uses 36 calendar annualization. So this is kind of a difficult concept to understand, but volatility is one of these things. If you talk about volatility for a day versus a month versus a year, obviously a big day, a big single day move might be 3%, but for an overall year, that would be nothing. So technically, you can convert from one to the other. If you take the average daily volatility and multiply it by the square root of 365, that gives you a prediction of using a calendar basis of what your volatility for a year would look like. So that's what the CBOE uses for the VIX options.
Okay.
The problem is that really isn't all that accurate, and the shorter in time-wise you get, the less accurate that is. So I think the real metric should be how many trading days you have till this option expires. And so you have the case with VXST where weekends start becoming a significant percentage of the overall time. And that, like on Mondays, what you almost always see on Mondays is VXST takes a big jump up. I think it was up 5% today, even though vol in general was down pretty hard. So, because of that artifact, I think it's difficult to correct for that. And I think if you got plus 10% moves just coming from nothing, to me that's not a very good indicator when you have artifacts like that.
Oh wow! So be careful with that one. Yeah.
Yeah, certainly be aware that it's going to drop on Friday and jump on Mondays. So that
I noticed today, just with the regular VIX, that markets were futures markets were up pre-open, but the VIX was up like 30 cents. It didn't, and I noticed that on Mondays. It seemed, maybe I'm just imagining it, but it seemed like Fridays sometimes the VIX goes down more than expected.
Mm-hmm.
And like today, it was up 30 cents with equity markets up, and
right.
You would think it would have been unched down.
Well, the VIX has the same issue. It's just not as pronounced. It's more of like a 2.5% bump on Mondays. So that's just because of this annualization artifact. If the market's flat, you'll see about a 2.5% move up in the VIX on Mondays.
So I don't quite understand it. So it's just the formula is giving a wrong reading for the VIX based on how many days to go. Is that what it is?
Right. Okay. Because the analogy that I would use is, let's say you're a gambler and you're monitoring the net worth of this gambler. So using the calendar method, you would say this gambler's net worth would drop every day. Well, what if he doesn't gamble on the weekends? Then his net worth is stable during those days that he's not gambling. And SPX options are the same way. As if the market is not trading, then they're not dropping in value.
Now I know when I was in equities as a market maker, we would on Fridays during the day we would start moving our order puts forward a day. So if options, I'm just trying to think of how to make money on this. So if I thought that it was going to be a volatile week next week, it would be just as maybe it would be not a bad idea to buy options on Friday as opposed to Monday. The prices would probably be almost exactly the same. Like that weekend decay doesn't seem like it's really there sometimes. But
yeah, well, the thing that's interesting is to look at prices, because if you look at an option on Friday, it's using an annualization factor based on how many days that option has until expiration. So that's what generates the implied volatility. So even if that option stays at exactly the same price on Monday, it's going to have a different implied volatility number because you're using a lower number of days until expiration.
Right.
So since the price,
yeah.
So if the price stays the same, that looks like an increase in implied volatility.
Right. Yeah. So exactly. Yeah. So it's like, for example, I'm short options, so my theta, or the dollars I make per day being short them, shows like 100 a day. So I'm like, oh, I get a free $200 for the weekend.
Right.
But you don't just come in Monday and there's $200 more in your account. It's not the way it works. And it's that same. I think it's that same little calculation coming into play there. So if I wanted to, you were mentioning a strategy that you were using in the SVXY to short volatility when I talked to you before. But I was wondering if I was interested in playing the short volatility game and I had, let's say, $1,000 and was willing to be patient for, let's say, 6 months or a year,
Mm-hmm.
what would be a good spot to just to put $1,000 in?
So I think if you're talking play money, stuff that you can afford to lose, then you can go in certainly buying an SVXY or an XIV. That has historically been since 2011 has been a good bet. And a year is probably long enough for you to weather most of the sort of drawdowns, because there have been 50% drawdowns since 2011, but they do tend to recover. So if you just want to park it and not look at it, and you're willing to wait that kind of time frame, that's probably going to be okay for you. Now, if you start increasing the amount of money and your sensitivity to drawdowns, then I think looking at hedging strategies, not so much hedging and more protection. So, for example, if one way to go is to short VXX, well, if you look at that, it's not that expensive to buy protective calls that are, let's say you short it at 25, and you can buy 50 calls, strike 50 calls that aren't that expensive. And so what that does is really going to limit the damage if you have a tsunami or an earthquake or geopolitical disaster, those sorts of things.
We call that buying our wings.
Yeah, exactly.
In trading.
Yeah, and so the strategy that I'm using currently is to buy like SVXY, and then to buy puts. You can buy puts that are 20-30% out of the money, and they're not cheap, but that gives you a floor. You're not going to get hammered down, because when these inverse, as you mentioned, when these inverse funds, when volatility spikes, these inverse funds really take a beating in a big hurry. And particularly if you're in options, those will usually expire before you recover. So I think having some sort of protection in place is a really sound principle.
I know one of the traders I know who makes the most money trading in UVXY. His strategy is to sit on the sidelines until there's a spike, mm-hmm. and then jump on it. Mm-hmm. And I know that volatility could stay elevated for a day, a week, even a month or two, mm-hmm. but eventually it's gonna go back down. And mm-hmm. usually these days it goes back down within a couple of days.
Right.
So one strategy I've heard, which is a way of getting in when it spikes, is to actually to sell SVXY puts. And so you keep collecting income from selling the out of the money puts until that one day that it actually spikes, at which point you are put stock to you and you actually own the stock at a lower price, or the mm-hmm. ETF at a lower price, mm-hmm. and can go on from there.
Mm-hmm. So I think the issue there is, since 2011, that's worked pretty well. If you really get into a true 20% correction or a bear market, then people just have short memories. They forget what happened 6 years ago. But there's no question in my mind that we will have bear markets and big corrections. Volatility will come back with a vengeance. So just because it's worked the last 5 times doesn't mean it's going to work, indefinitely. And people need to have an exit strategy. I think that's the most important thing, is to just have really made a decision beforehand when they'll take their losses and get out, or put enough protection in place that they don't have to get out.
So you think we will have another spike? I mean,
no question. Yeah.
And it's going to be significant at some point.
Mm-hmm. Well, I think fear is pretty inherent to the human condition, and there's nothing scarier than people with retirement funds, or people they tend to the fear tends to panic at the bottom when everybody is saying that this won't stop and end of the world sort of stuff. So, the media and all your friends, I remember conversations, in 2008, 2009, where, were people saying, well, it won't recover for 20 years and all the doom and gloom. And it's hard to go against that.
Well, it's tough trading. This has been a winning trade, shorting volatility for a while. But as soon as stuff starts to go against us, even the spike to 17 in UVXY last week, as soon as it starts to go against, it seems like everybody, you need to have that conviction to stick with your position to some extent, because everybody around you seems to be saying it's a new normal now. UVXY is going to turn around and it's going to go up from now on. We're in backwardation forever. And so it's not a layup shorting volatility. I mean, it takes the discipline and the focus of any other trade. There's no free money out there in the stock market.
No, that's right. Well, and as you mentioned there, when we talked before, is there really are two camps. There's a group that's just convinced that everything is just going to go to hell in a handbasket, and that volatility is going to spike up and is way overdue. And eventually they'll be right. And then there's a lot of people that have done very well with their short volatility trade, and I think the danger there is for them to become overconfident.
So can you give me a date as to when we're going to spike?
No, in my last article on the VIX model, I don't know if you had a chance to read that, but the model that really matches reality pretty well is VIX spikes are like a roulette table with 86 reds and 1 black, or I guess the other way around would be better, 86 blacks and 1 red. And so it really is random. That's the way the statistics look. You spin every day, you roll that roulette table, and if it lands on black, the inverse vol folks are happy, and if it lands on red, and there's nothing that prevents you from hitting red on successive days. That's just statistics.
Well, it is nice to actually, though, to be trading something that is based on statistics as opposed to just hocus pocus. And I just interviewed somebody yesterday who's teaches people technical analysis, and I prefer to sometimes to stick in the realm. Although knowing your charts, you got to know your charts, and if enough people follow a pattern, then it becomes reality. But I like to be on the side of the odds, which at this point seems to be that we're going lower on volatility, or at least these products seem to have real edge in them. From Contango.
Right, the Contango, the term structure, that is asymmetry there, where there is a, normally the market is pretty close to a 50-50 call, but when you have the term VIX futures term structure in Contango, there's definitely an edge.
I wanted to ask you, I know UVXY is a 2x leverage ETF. How do they accomplish that? Do they have to sort of back up and turn around everything when it goes up or when it goes down each time it upticks or downticks? How do they accomplish?
Yeah, it's actually real simple. Is what they commit to do, and they're very good at it, is getting a 2x move, 2x the, let's say, VXX move on a day. So if VXX goes up 10%, they'll go up 20%. So the way they do that is just with margin and leverage. They margin requirements on VIX futures are such that they don't have to invest all the assets under management. They can just satisfy margin, and they just buy twice as much, and they have enough cash to do that. So go ahead.
I was wondering, I know when I look on the daily holdings of UVXY, it shows a cash component. It usually looks like it's like $400 million or something.
Right. Yeah.
What do they have to keep it at a certain amount? And what is that for? Do they just collect interest from us, or what is that?
Well, yeah,
for?
They don't. I'm sure they get something from that, but essentially that's just driven by, they don't put any more into the futures than they have to meet the margin requirements. And whatever's left is just put in short-term treasury bills, so that they're earning interest on it. So the thing they have to do that's interesting at the end of the day, there's two things that happens. One is they change the percentage of M1 and M2 contracts. So that's that's a monthly roll. So that's a very predictable and known quantity. The other thing is that they have to, that's one form of rebalancing, which is really kind of, very methodical. The other is that they have to rebalance the amount that they're long at that point. So basically it's twice the percentage move overall that they have to rebalance. So let's say they go up 10%, then they have to buy a lot more futures at close so that they have that same 2x multiplier the next day.
Well, I originally got into the UVXY because I was investigating leveraged ETFs and the decay associated with them. I was looking at the 3x ones because that has the most. And I was looking at UGAS, DGAS, which I'm not sure if that's 2 or 3 times those ones. But I was thinking, well, I'll sell both UGAS and DGAS and try to balance them, which is the hard part. And and it would be a moneymaker. But so how do we get the most decay from that drift from them having to rebalance up and down? Do we want it to be like up 10% one day and then down 10% the next, or is that going to cause us more decay for us shorts than sideways?
Yeah, that's the thing that people don't understand on the leveraged funds is you hear a lot of discussion about what I call volatility decay. So if there's a lot of moves up and down, you mentioned plus 10, minus 10, they do erode because of compounding issues. If you go down 10%, you have to go up more than 10% the next day just to be even. So that's the drag aspect of it. But the other part of it is a trending factor. So if let's say UVXY goes up 5% 3 days in a row, it actually will outperform its 2x leverage at that point significantly. So you get a compounding effect that benefits the holder of those funds.
Oh, wow.
So that's the tricky part when you talk about shorting 2x long, 2x short, is that if you're in a trending market, the one of those is going to definitely do better than you would expect.
Yeah, that's like sort of out of your control. The little factor of it that's sort of out of your control.
So it's a path dependency is another way to think about that. Is that the path that the underlying takes is important as to whether you make or lose money.
Well, it certainly has been an amazing year for the vol products. I got involved last year, and it seemed, when days are coming together like today, yesterday, the last couple of days, it seems like such a layup and it's so easy. But then you go through periods like August where we went sideways for a month to up, and it's I want to ask you about one last thing, is that as we get towards expiration, and like the week before expiration, like we're coming up now, we're coming close to expiration. I don't know how many days we have left, but it's getting closer. Is it more volatile that last week before expiration, the futures, than the first week?
Well, definitely, if a VIX future has a week to go, there's a pretty dramatic ramp up in how well it tracks the VIX. And that effectively is volatility, because the VIX is pretty volatile. It's average, 2/3 of the time it's going to be at least plus or minus 6% on a daily basis. That's just the standard deviation on it. So the VXX, for example, is going to be about half of that, 3%. A VIX future with 3 days to go is going to be getting to be in like the 70% of the volatility of the VIX.
Yeah, because it seems like that spread between spot and M1 has a lot more give to it the first couple of weeks. It can move around from like $2 away to even, or even go inverse a little bit. But as you get right before expiration, it tends to really narrow. But I've noticed on expiration that it doesn't go to zero on expiration day. I mean, we're sort of told that that's what happens, is that it's gonna converge exactly to zero.
Okay.
But it doesn't seem like it does. And I think part of that is that everybody's already rolled into the next month by then, and so there's not that much liquidity at the last day. But
well, there's an underlying issue there is that the VIX calculation uses mid-priced, so it's using let's say you have a 2000 strike SPX call. Well, the way the VIX is calculated is it takes the bid and ask price and it takes the middle of that. So that's not a trade price. So when the VIX futures actually settle, when they expire, there's actual transaction with SPX options trading. And so they're going to actually be at their bid or ask prices. And also there's some uncertainty as to how many option series actually, how many strikes actually trade.
Right. So it's marks then is what you're saying in the end.
Right. Exactly. So it's a real life transaction with strips of SPX options, puts and calls being bought and sold. So, it's gotten better, but it's certainly not surprising to see a couple % difference between what the futures and options settle at versus what the VIX opens at.
That makes sense. Yeah, that makes sense. Well, listen, I really appreciate you coming and talking with me for a little while. Like I said, we really we love your all your articles. I also follow you on Seeking Alpha, and I'm going to link your website to this video.
Okay, great.
And I wish you a ton of luck in the future. I want to thank you again for coming back and doing this again after I messed up the sound so badly.
No problem.
It's growing pains.
No, it's a fascinating area. There's a lot going in the volatility space, and it's a very deep subject. There's lots of non-obvious things about it.
Well, you've definitely cleared up a few things for me today. And I really appreciate it. And I can say on behalf of all my buddies, thank you so much for all your articles.
Sure.
We love to read your stuff.
Cool. Good to hear.
All right. Well, I hope to maybe we'll talk again sometime. And thanks for doing this.
You bet.
All right. All right. So I'll just shut it off after that. But that was good, huh?
Yeah. No, it was good.
It's fun. You've been the most fascinating guest so far, just because of the subject matter is so fascinating.
Yeah, well, cool. Yeah, I know when you're talking, you mentioned you were talking about technical analysis. It's hard for me to stay engaged sometimes on the. I think the more psychology. Actually, I think on Bitcoin it might, because that feels to me like that's almost pure psychology right now. I think it might work better there, but.
Well, this guy that I interviewed yesterday, his name's Dan McDermott, and he just does just the basic technical analysis stuff. Like he doesn't get into the really complicated names of bizarre patterns, but just the basics. And I was always taught to the extent that other people are using it, it has some basis. I never had any inkling as to how somebody would trade something like currency pairs or straight futures, and so they have to be using something. I don't know how you would do that. I'm an options trader. I'm about probability. So
that's now. How long were you an option trader?
I got to the SIBO in 1994. And I was trained by a company. Actually, the guys who trained me was a company called Group 1 Trading. They were all market makers in the PSE in San Francisco back in the 80s.
Okay.
And so this one guy, Gary Sparks, he used to buy his first trading sheets from Blair Hull, who was coming up with, before there were even puts, I guess, there were calls only at first. But I started in 94. I did a year of training at the P Coast. Where we were specialists in some issues. We were also specialists at the SIBO in some issues. And we were trained to trade in several different ways. Most of all, we were taught to see where in the historical volatility range our stocks were at the moment. And so if you're in the middle of the range, we would have relatively small positions. The low end of the range, we would look to accumulate a little bit. And the high end of the range, we would look to sell a little bit. And we had a lot of capital, so that allowed us to still always have bullets. And it was a great time. We were also taught to move price discovery, move the market. We were taught to go into whatever pit we were in and try to influence the price as much as we could. So we'd get to know, we trade very illiquid issues. And so we get to know our order flow, exactly what we could anticipate, exactly what was going to come in the pit. And so if we knew a calendar spread was coming in, we'd start moving the markets in our favor. You know, it was a game. Our customers were all smart money people who were trying to, you know, who were wired and insiders. And so that was who we were, who our customers were. So we had to try to be smarter than them and faster than them.
So this was all options? Or?
I was an equity options market maker at the CBOE.
Okay. So did you have to worry about managing the delta hedging, for example?
Yes, we had. I had a clerk behind me, and usually I would hedge directly with stocks right away.
Right.
So I'd come and do a trade. You know, someone would sell me 50 calls. I'd turn around and go sell 2,000. You know, if somebody sold me 50 at the money calls, I'd sell 2,500 shares at the market if there was a 50 delta. But there were a lot of games being played with, for example, at one point the stocks were multiply listed, so there'd be a market being made in Chicago and in New York, and we'd have guys in each pit. And so if something would be quoted, we'd be on our computer talking to the guys at the other pits, trying to. But a lot of the pits were so illiquid that we sort of worked together to make the market and make the price. And so I was trained how to move. You know, the only things we could do is say our market and our size. We couldn't control what orders came in. We had to be the counterparty to everything. There's no picking or choosing.
Did you have to manage the Greeks in your book?
Yeah. So we had our delta, gamma, theta.
So were you buying options to then, you know, manage your risk in your book?
You mean, well, each pit had like 20 stocks. And then we had a guy in the NASDAQ and then the SPX, and we would generally keep everything separate.
Okay. So if you're trying to manage gamma risk, for example, you can't just do that with stock, though, can you?
Well, if we're trying to manage gamma risk, basically we would take on any position for the right price. So if somebody is going to take all our gamma away, we're gonna keep raising prices until someone comes on the other side to sell it to us. All right. And if somebody starts selling, if someone comes in and starts buying stuff from me at a cheap price, I'll turn around and pay the offer and scramble to get it back. I mean, it's all about just price discovery. You know, we don't defend any level, and we just move. And there's huge money to be made that way, but that world is a little bit gone now, because now markets are tighter. They're in decimals now, and they can find somebody else to sell it to them if it's not you.
Well, and I assume the computer models are way more sophisticated too, I would think. Or is that your impression? Or
well, we had pretty good Black-Scholes models for sheets where we could change volatility. We could input any inputs into the Black-Scholes model we wanted to.
But that wouldn't give you the skew, though, would it?
Well, we had skew.
Okay, you had some skew that because you have to, basically, I would think.
Yeah, I mean, individual stocks we weren't using as much of a skew. I mean, if someone was selling me out of the money calls, I would actively lean them down in the skew, because I didn't want to be selling stock against them very much. But it was really, you really have to evaluate your position on an option by option basis and say, okay, are these hard deltas or soft deltas, for example, the way we refer to them? Like, not only what does the Greeks say, but where are they coming from? So it's a whole, it's definitely an art.
Yeah, no, definitely.
But it's been a real transition to go to retail for me. It's a relief that I don't have to be counterparty to everything. I can pick what position I want now. Right. But there's not the free money that was there before. Before we had buying the bid, selling the offer. You know, we're 1.5, 2 on some calls. They want to buy 100. Okay, I'll sell you 20 at 2. I'll sell you 50 at 2 and 20, 225. You
Wow.
know, and I'll sell you the balance at 275.
Yeah, yeah.
And then
no, that's it.
And then when you know the guy's coming to roll them, you lean them down 50 cents.
Yeah.
So it was
different world.
Different world, yeah.
Huh.
But it was an interesting place to see, Bo. But yeah, so I've been having fun. I've met some great people doing this video stuff. I'm gonna talk to this guy, Russell. I think his name's Russell Rhodes. He's a SIBO guy.
Right.
Next week. So that'll be fun. Yeah.
Yeah. No, he's a good guy.
Yeah. So he's another guy who's sort of another guru.
Yeah. No, he knows his stuff.
Yeah. What should I ask him?
Yeah. I'm always curious about the market making on VIX futures. If you can get any information on that, that would be, because I think this whole ARB issue of, what is this relationship between SPX options and VIX futures? Because, and is that turning around in terms of, is it starting to bleed back into the SPX options?
Yeah, because it seems like those guys are they're not tracking the VIX at all sometimes. I mean, and a lot of times, especially with a spike, they're anticipating it going back down. It seems like they do not bring them up.
That's right. The mean reversion factor is pretty big. But I don't know how much of that is just algos, but there's got to be some arbitrage in there somewhere. And the sense I'm getting now is that the market makers on the VIX futures don't use SPX options much. I think they're doing calendars and hedging out some risk with the VIX options. That's my hypothesis right now. But I have, I try to get that kind of information, but it's pretty.
Well, I have a friend who still works on the floor at the SIBO, and so I would like to go down there and hang out with him. And also, I did notice my old company. I worked for a company called Group One Trading. We still have guys there because the last SIBO TV was hosted by a Group One guy. So I should probably try to work my magic with those guys. I'm gonna have another ex Group One trader on in a couple of days. But I know a couple weeks ago when we weren't getting quotes. I was calling the SIBO to see if he could just read it off the screen for us or something like that. I remember you had pointed out on Twitter how there was a bad print in the VIX. It was 8.5 or something that was way off.
Yeah. Yeah.
That stuff happens.
No, for example, it's possible that they're doing and at the money straddles and delta hedging SPX calls for SPX options. So
yeah, it is possible.
They might be doing some things like that because the VIX is a little contrived. They really the whole object there was to make it so that they could do a static hedge. They weren't as interested about whether it was really an accurate volatility metric. It was more about, can we commercialize this? So that's
well, I mean, now, the volume has exploded so much that I think it's beyond what they thought was going to happen. And it certainly is beyond what I thought was going to happen. But I don't picture where those futures guys are. I'll sit there though on my Thinkorswim and I'll watch the back months trade sometimes just on the in the volume and try to figure out what's going on. But it's pretty oblique, or what's that word? Opaque.
Yeah. Opaque. Well, I think the other factor is everybody talks about short vol exploding, but we're still only talking a couple billion of AUM on the exchange traded funds.
When people say there's going to be a huge unwind, everybody's short vol, I don't believe that because it makes it sound like every short trade that I've ever done in my life is stacked in a pile, and they're all going to. When the reality is, we've done short trades and we've taken them off. We put them on. And there's got to be people buying this stuff, or
Right.
So I don't.
Yeah. So, this rebalance I mentioned with UVXY, where they have to go in and re-leverage, that's the same for the inverse. They have to buy also if vol goes up. But it's still, the amount of money we're talking about just isn't huge. So I think they have to wave their arms and say, well, there's a lot of people that are going to go sell out equity portfolios if vol starts picking up. Which I think it's going to happen, but is that this chain reaction disaster? I don't really see it. So,
yeah, I don't see it either. I obviously see some individuals blowing out, of course, but the big unwind is I think that's just somebody's just imagining things in their head.
Well, there's always the you worry about the black swan. Certainly like August 2015, the market makers, it was pretty ugly. IVV had a 30% flash crash. That was an $80 billion ETF, and that was a sloppy open, the S&P 500, and the authorized participants just they let go of the stick. They just let it float or sink. So that could happen again.
They they have on the floor, they did when I was there, a fast market where like all the rules are relaxed and you can kind of spread stuff out. And it's traditionally the best time to make money. And for me, like on a day like today, I'm tempted to take my position completely off because it's made money. We're down at the lows again. You want to have those bullets for when, because those times where they say, oh, it's going to be awful, the great unwind, those are actually the opportunity moments in the market that you want to be there and scalpy away,
Right.
But yeah, I don't know. We'll see going forward. I think VIX is only going to grow. So.
Yeah, I agree.
Interesting. Anyways, thanks so much, and definitely stay in touch. I will put this together and send you a link.
All right, sounds good.
And sound, I think, is better this time, which is great. I pressed the wrong button.
Yeah. Yeah. Well, let's hope that it was recording this time. So
it looks like it was. It's going to be fine.
Good.
All right. Thanks so much.
All right, Dave.
And I'll talk to you soon.
All right. Sounds good.
All right. Bye-bye.